Michael Fox, and this is the Prospector Podcast. And I have joining me, I have Mike McGlone, the Chief Commodities Analyst at Bloomberg. Welcome, Mike.
Oh, hello, Michael. It's always good to be back, and always good to talk to you.
Yeah, we had a nice chat actually in Miami. We talked about the one thing that wasn't on everybody's bingo card, and that was the high copper prices. And we're a month later. They're still here, but rather than us talking about it being a good thing, you came up with a really compelling argument about a week and a half ago that indicates, and I can't say I disagree, that these high copper prices are counterindicative and in fact are a bad thing.
Yes, well, I have to admit, own your mistakes at first. The main wrong market I've gotten wrong so far is copper. As of today, just made a new high. It's trading $5.20 a pound, and it's doing it on the back of the widest spread between CME traded copper versus LME traded copper ever. Now, it's not. It's obviously we're all worried about tariffs on U.S. imported copper. The fact is the Commerce Department is supposed to be making a recommendation for tariffs potentially by the end of the year. There's been no substantial tariffs yet on U.S. copper that I know of. And so this is all apprehensive. The key thing that's unique about it, Michael, is I was able to put a pretty good peak in copper last year when it peaked at 520, went down to 4, because it was all on the back of massive speculation, managed money net futures positions in futures. They jumped up to 30, almost 35% of total open interest. Now they're only running about 10. So you're not seeing major signs of short covering and CME related copper, but something's going on behind the scenes that I just don't understand as much. And copper's lifting, obviously U.S. copper is lifting, CME copper is lifting industrial metals, but for the wrong reasons, for U.S. tariffs. It's not because of, massive demand pull forces out of China and Europe and the U.S. It's because of U.S. tariffs, which I'm really concerned about. It's also bucking the trend of the lower stock market. But hey, it's doing it. It's the best performing major commodity this year, up about 30%. Right behind it's gold, about 15%. Now, gold makes sense to me. Stock market's going down, interest rates are going lower, yields are declining. The VIX volatility index, volatility in the stock market's going up. That's what you expect in gold. But copper's the outlier. The question is what's the duration of this rally? I suspect it's just going to squeeze as many weak shorts as possible and then pop right back down to 4.
Yeah, like it reminds me, and this is going to sound like a weird analogy, but it reminds me of the toilet paper shortage of 2020, 2021 during COVID, where everybody lost their heads and ran out and started hoarding toilet paper. I don't see a positive net out of the United States tariffing copper. There's not a whole lot of copper production happening in the United States, and they rely on foreign suppliers of this copper just simply because they haven't got the mines to produce their own. And that's not going to change anytime soon. So I shouldn't say I don't see them doing it because you're never really sure, but I actually can't see them putting a tariff on copper and, because it would be counterproductive to their own economic well-being.
Well, this is a good trial balloon. That's why most of the time when commodities spike like this, they're their own worst enemies, i.e. look at crude oil. It's about $68 a barrel. The high in 2022 was 130. Why is it down at 68? Because it went up too much. Commodities typically go down because they went up. You gave the example toilet paper. Now it's eggs that we're seeing hitting the table recently. The question is copper. And the key thing I'm pointing about copper is I point out it's most expensive ever versus CME copper is most expensive versus LME. It's also the most expensive ever versus a Bloomberg Industrial Metals Index. So it's way out of whack. And you know what happens with arbitrageurs and when these things change. So as a commodity strategist, I think, this is probably not enduring. But the key thing is it's its own worst enemy because it's a great trial balloon. It's just showing the Trump administration, okay, the U.S. has a deficit of copper. We import maybe 50% of it. We have a surplus of crude oil and grains. That's why they're down. And we might have, we have to export those. But this is a little trial balloon to the Trump administration. Yeah, well, maybe we should institute instant tariffs on copper right away because this is going to be completely counterproductive to our goals of lower inflation, lower yields. Our copper has a very high correlation with yields and U.S. industrial production. And so and it's also part of trying to reshore a lot of U.S. production. Pumping up the price of copper is not a good idea. And just like lower energy, it helps bring industry back to the U.S. So I think this is part of they're in the investigation mode right now, and the price of copper is telling them, okay, we probably shouldn't do high tariffs on copper right away. So that's what I think most managed money net positions, hedge funds who were way on top of the rally last year, are just not joining this one this year.
So, what is going to make copper break down to the downside? Is it actual signs of a recession, or is it capitulation by the Trump administration that no, they're not going to tariff copper?
Well, that's the answer is yes. Now we know this can happen in one tweet, or I should say, social media post. Can't say tweet anymore. I call it an X. So that could happen, and certainly I think the number one force for me, all commodities, all markets right now, is if this correction U.S. stock market continues, which is the bias of our chief equity strategist, Gina Martin Adams. She thinks we probably get another 10% correction in the S&P 500. That means the tide goes out for everything, particularly industrial metals, if history is a guide, and yields. And bond yields, all things that the government, the Trump administration wants, which kind of is why it makes sense. I have to mention that because to me, we're on the cusp of what really matters. And this whole risk of recession is just starting to tilt back. Now, I can't think of a better recession in history than since 1930, 1929, which is the last time the U.S. stock market was this expensive versus GDP, 2 times GDP on the way up, then the stock market going back down. And we have all signs tilting that way. It's the unprecedented austerity in the U.S. Tariffs are going to be a major pressure, and one of the number one reasons that a lot of reasons U.S. corporations offshored production was profits. Now you're going to squeeze those profits in earnings, and we're so ripe for a backup. I look at things like the volatility index and the VIX. Its 200-day moving average is just bottom from a 6-year low, so volatility is going up. Stock market potentially going down. Copper is kind of in the way. It's going up for the wrong reason. So to me, one little social media post can do it. The stock market continuing to go down. So I'll put up prerequisites for copper to stay strong, as you have to have. They think the Trump administration to stay on course, stalwart about 20 to 30% tariffs on imported copper in the U.S. They can't pull back on that, and you need the stock market to keep going up. I think are 2 of the top prerequisites for copper to stay at record highs, which it is right now.
Yeah, and if I was a batter sitting in the batter's box right now, I'd been swinging a miss at both of those. So I'd be 2-0, 0-2, and protecting the plate from here on in. So that would take us around to the gold, which hit record highs last week. And again, another economic indicator, but it's probably more indicating the rough waters that are coming than the copper is indicating.
So as of today, March 25th, gold is beating the AI-driven S&P 500 total return on a 1, 2, 3, and 4-year basis. That's not a good sign for the U.S. stock market. And to me, that's indicative of what's happening with gold. The most significant thing that's happening in gold this year, other than getting to $3,000 an ounce, is this shift towards gold ETF inflows from outflows. We've had gold ETF outflows for 4 years in a row, according to the Bloomberg data showing total ETF holdings in gold, and they've jumped about almost 5 million ounces this year, almost more than 6% of total gold holdings. And at the same time, things like cryptocurrencies are turning down, volatility in stock markets turning up, stock markets turning down. To me, this is early days of something just getting started. And for gold, I think we know central banks have been big buyers for good reason. That might be curtailed a little bit with prices at 3,000. So right now with gold at 3,000, it's stretched. It's a bit overbought, as some people would say. So I look at it here at these levels as it's more of a put on the U.S. stock market. I think the fuel for gold to really accelerate in its rally from here, it's consolidating from these levels, is the U.S. stock market going down. That would be more the put factor, because that would signal deflation, which is, I think, normal, and we're kind of overdue for that. It's historically proves that happens. So I look at gold as still quite bullish, but it's the investors are just starting to jump in. It's a good sign, but it's pretty overbought. It's one thing I've always compared it to is you can go back historically and look at it versus its 60-month moving average. It's 50% above that level. That was basically where it peaked initially at 2000, and then it dropped back to 1600 or so, but it needs so it needs bull fuel here, and the number one measure for bull, I think, target, number one place to look for bull fuel is the U.S. stock market continuing to decline, which, by the way, I mentioned is the outlook from our BI, Bloomberg Intelligence Group.
Yeah, and essentially, that's going to drag the copper prices down, and it'll keep the gold prices elevated. So, again, the two indicators for the strength and of the economy are giving us different messages, and it would appear that gold is utilizing its doctorate better than the copper is.
Well, there you go. I like how you put that. And it's also a good lesson in markets. If it seems easy, something's wrong. And that to me was part of what happened when Bitcoin peaked at 100,000. It just seemed too easy and too bullish. And it's proven it's not that easy. It's too expensive. And I have to mention that because to me, that's part of the reason gold is starting to gain investor inflows, because we had the biggest ETF launch ever in history last year with US Bitcoin ETFs. To me, that was a frenzy that put in the peak. And now we're getting back to reality of relative value, finding out Bitcoin is just a leveraged version of beta. It's down 30% from its peak, or back 30% when the S&P 500 dropped 10%. That's like a 3 times beta. And gold's hitting record highs. So people are finding out by adding Bitcoin to their portfolios, they're adding a lot of risk to the stock market. But by adding gold, it has a history of zero correlations. And at this point, it's much more negatively correlated to the stock market. So if you're worried about the stock market, you're more likely to be buying gold in U.S. Treasury long bonds, which, by the way, are eating much more than they do in Canada.
Yeah, our economy and our central bank seems to be going a completely different direction than what the U.S. central bank is doing. So, as gold pushed towards this $3,000 price, there were a lot of pundits out there that suggested 3,200 was going to be the topper. Can gold still get there before it starts to correct, or is it just simply it got to where it is too quickly and it's too far out over its skis?
Oh, it's like the best way to describe it is right now it needs the bull market needs fuel. So I seek where are measures of where potential places for fuel. The top one is U.S. stock market continuing to go down. Now initially, if it goes down hard, like in 2008, that's a pressure. Hit bids. It's kind of a margin call thing for gold. But overall, gold has been doing some major shifting. You see managed money net positions who were way long, lightening up, and all that switching over to longer term holdings in ETFs. So I think gold's on a pretty good long term trajectory. Part of the reason, because I'm bearish the equity market, I think that's due for some normalization, meaning at 2 times GDP, that's pretty high. Just in 2019, it was 1.5 times GDP. So we'll go back to 1.5. That's really bullish for gold. But trying to put on, my call from 2000 was to go to 3,000. Now, I have to admit, I was way too early on that one. Started calling for that in 2020. But now that we're here, trying to put $100 here, $100 there, that's for the strategists who, like me, used to have hair. I just kind of don't do that anymore. It's like, yeah, good luck. And long term, the way I see it now as an ex-option trader, ex-hedge fund guy, and ex-commodity traders, the outlater trade I see for right now is structuring some form of potential put strategies on copper, which has been proven wrong. It keeps going, but now it's made a new high. I mean, the optionality is great. And in gold, it's already gone up so much. So kind of laying low. And if you've been long, you probably not have a place to add. So I just look at it. It might hover here for a while. It needs bull fuel, and then we just have to figure out what that's going to be. Let's see what the next move in the market is.
For those in the buy the dip crowd, where do you figure the new floor is for gold?
I'd be kind of surprised if it got down to 2,700, which means it's pretty good support. I think that's about the 200-day moving average.
And then from there, it's just a matter of time before it bounces up again.
Yeah, it's just how it's going to change. It's actually a 200-day mover, that's about 2,600. So around 27, I think, is a good support. That's where the 50 and 100 come in. And they've been holding the 100-day moving average forever. It's going to be what's the next big story. But to me, the big picture macro is that shift to inflows and ETFs, which means people are giving up on the equity market or lightening up. And I do agree that we're so overdue for that recession. The thing that you've been calling for eventually will happen. And I think the number one catalyst for that is it's already starting. You see it in consumer sentiment. I think people get it. We're getting very expensive equities and they're looking for alternatives. So I think that's where gold comes into play. But I have to mention, Keith, and gold it's breaking out versus S&P 500. I just look at that ratio. The 200-day Bollinger Band is the narrowest in 30 years. The thing I want to point out, though, what I really seen that's notable is I mentioned bonds, Michael, because the U.S. Treasury 10-year note at 4.3% is exceptionally high on a global basis. Look at versus Canada, look at versus Japan, versus China. I mean, that's over 200 basis points. It's very high versus the top 5 countries in the rest of the world. It's still very high yield. So to me, and also then I like to compare the gold price versus we have the U.S. The Bloomberg 20+ Treasury bond index. You compare it to a Treasury bond index. I can go back 30 years, and gold's the most expensive versus bonds ever. So that's why I think the next big trade is going to be, if we get a little backup in equities, another 10%, that's deflation. Gold's already done pretty well. It does, continues to do well, but I think that's a key trade to kick the bond market and, drop. It's 430 right now, just drop towards Canada, which is 303%. So it'd be 130 basis points. I think that's the next big trade I'm kind of eyeing to see what catalyst might trigger it.
Yeah, well, and it could very well be that R word, and I think this time around, when the recession comes, it'll be a real recession, not a Beetlejuice recession like the last one, where it really wasn't. They claimed it wasn't a recession. We just said its name too many times.
It's important to mention that because the lessons of the last recession were the lessons of the biggest liquidity pump in history. If we as humans have not learned the lesson of adding too much liquidity to the system and the inflation that resulted, then shame on us. And I think we have learned that. So as we tilt towards a normal reversion on the back of massive liquidity pumps and risk assets, cryptos are the lead, U.S. stock market's the hottest one in the market. As we head towards a normal reversion of that, and we need to add liquidity to the system. But part of the reason we have sticky inflation is because the wealth effect in the U.S. So I think we've reached the apex of adding liquidity and pumping up risk assets. 2 times GDP. Last year, we added $12 trillion approximately to U.S. stock market capitalization. That was about 40% of GDP. That's the most ever of wealth effect. Cal surprise that we have course PCE running 3.5% versus the Fed's target of 2%. I liked what Jim Bianco says. He says we've had inflation running above target for 47 straight months. And the Fed made a mistake of starting to ease last year. The bond market told them they shouldn't have. And the stock market just added to inflation. So now we're stuck. The Fed's stuck. They can't ease. We're completely pulling back on the fiscal stimulus from the U.S. and we have tariffs. This is all pretty bearish stuff for risk assets, and gold's a risk-off asset.
Yeah, and it's pretty bearish stuff for an overall economy if the Fed's out of quivers and it's that it could take out to fight it too. So as I often say, forewarned is forearmed in a lot of cases, and I think recirculating ourselves back to this conversation today should help forewarn a lot of our listeners about that. You and I, we're going to see each other again soon, I understand. We're both speaking at the New York chapter of the SMEs conference coming up in May, the 19th to the 21st, I believe.
I'm looking forward to it in New York. It's one of my favorite conferences. I plan on spending the week there, and I'm looking forward to catching up with you. We always have some great discussions.
Yeah, there's the on microphone discussions and then the off microphone discussions, which are pretty entertaining unto themselves as well. But your discussion will be, I believe it'll be well timed and well listened to by the industry. I'm just going to yammer on about how they should, communicate better. So maybe not quite as interesting as your conversation, but we both get our stage time there in New York. But for those of our listeners that can't make it to New York to hear you speak, how's best to find your insights into the industry?
Well, on your program, thank you for having me. I'm on Twitter, I'm sorry, X, Mike McGlone, at Mike McGlone 11, and on LinkedIn, and also on Blue Sky.
Wonderful. And I'm sure between now and New York, with the rapid way things have been moving lately, there's going to be a reason for us to talk again. So I look forward to that chat.
Me too. Thank you, Michael.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.